Hello and good morning. Welcome to Pro Advice. My name is Shan Bhakta from REMAX Presidential South Florida Home Finder team. And at today's episode of Pro Advice, we are discussing about refinance or home equity line of credit. Which one is better for you? If you have some equity in the house and you want to get some cash out or whatever the reason, sometimes you may have a high interest rate and you want to adjust the interest rate. So today we're going to discuss with a pro, my friend George Alavi from Primary Residential Mortgage. And here is George. Hey George, welcome to the show.
Thank you. Thank you for having me, Sean, and good morning, everyone.
So George, let's start with you are a lender, you are a direct lender. Now, how long you're in the business, what kind of office you have, how many, what's the team setup or whatever you want to discuss about your business. Let's discuss about that first.
Sure. Well, first, my name is George Al-Halabi with Primary Residential Mortgage, and I want to take the opportunity to thank everyone for being here today. I've personally been in the business for approximately 15 years and literally funded thousands of loans myself and my team. At Primary Residential Mortgage, to give you an idea, last year we funded approximately $11 billion in loans with a B, So luckily the market has been great. Rates are, as everyone knows, probably historic lows. A lot of folks are taking advantage of this, because really this happens once in a decade, if not once in a lifetime, kind of, yes. Where like they're buying homes, refinancing, or getting lines of credit, and that's where that question come in. What should we do?
Exactly. So what do you think about this interest rate? Like, this is definitely a gift, because in your lifetime, what did you see? Like, what kind of interest you see at the earlier stage of your career, or like throughout the year? What did you see, and how you compare the interest rate now to back then?
Man, this is the lowest, not me, but maybe our grandparents and parents see. Actually, historically, this is the lowest interest rate has been in the United States. It's never been this low ever. If we want to go back to a little bit of a history, I can go back a little bit from before I started. I remember my parents-in-law had their mortgage at 10.5 interest rate. They bought their house in the 80s, and for them at the time, oh, wow, that was a great rate, compared to today's rates, where if you're well qualified, the interest rate are in the twos. It's like, it's almost free money. I don't want to say free, but it's like you're getting something for a 30-year fixed mortgage, for example, at 2.9. That is super low. I honestly, and no one can predict the future or the markets. Right. But I would say I don't see it going lower than this. So that's why I invite everybody, guys, stop waiting on the sidelines. If you want to pull the trigger, whether you want to refinance your home right now, get a line of credit, or even buy a new house, jump on it. If you buy a house today, let's assume this house stays at the same price a year down the road, but interest rates are higher. You're saving a ton of money when you consider a mortgage is for 30 years in majority of the times.
Yeah, so that is.
Go ahead.
That is 100% correct. Yeah, I actually did a calculation, like compared to 5% to 3%, and on a $300,000 house, just a basic house, we save ton of money just because of the 2% lower interest rate. Now, so one of the purpose of this message or the discussion today is a lot of our sellers, our past clients, we already sold them the house, or homeowners we know, they bought like 5, 6, 7, or 10 years back. They bought the house, they got a good price, and they have decent amount of equity. And then some of our clients, they want to buy an investment property, maybe get some cash out, kind of like not to just take the cash out, build wealth on that line of credit, or that refinance and do the cash out. So what do you think, what will be a better idea for someone who bought a house, like say 10 years back or 8 years back? has enough amount of equity, you think like better to do a refinance or better to get a line of credit? What's your advice on that?
Honestly, there's no one advice fit all. Like, unfortunately, like mortgage, there's no one right thing and another wrong. It's the best scenario that fits your need, pretty much. I know that's not a straight answer, and that's probably not what our audience want to hear, but that's the truth. Everyone's scenario is different. For Sean's scenarios, for example, a refinance might be better, but for George, a line of credit might be better. Now, what I can do is like explain a little bit of the differences between
Yes.
when you do a traditional refinance for a mortgage versus a line of credit. Before I jump into that, I want to give our audience, you commented something like, hey, we did the math on a $300,000 mortgage. If we compare it to a 5% interest rate, which, by the way, was here a year ago, in 2019, interest rates were in the fives, guys, versus 2020, end of 2020, now in 2021, where rates are in the high twos, but let's call it 3%. If you simply borrow $300,000. The difference is $345 every single month. If you have a
Wow.
$300,000 mortgage for a 30-year, with 3% interest rate versus a 5% interest rate. Now, when you consider this is a 30-year mortgage, and even look, majority of people don't keep their mortgage for 30 years, but let's say they keep it for 10 years. At $345 per month, if you multiply this, guys, by 120 months for 10 years only, the difference is you saved $41,400.
Wow.
I don't want to jump into the boring numbers, but I wanted to comment on this because a lot of people ask me, George, I want to wait a little bit more. Guys, for a lack of better term, don't get too greedy. Rates are at historic low. Jump in right now, buy or refinance. Now, to jump into our subject, the refinance versus the Helocs. Okay. Look, let's talk about the traditional mortgage versus a Heloc here. Whether you're buying or refinancing in here. Traditional mortgage, usually you're drawing the whole amount up front versus a line of credit, you can draw it at any time. Okay. That's one of the main differences in there. People sometimes want the freedom. Like, listen, George, I don't need the money today, but maybe I'll need it in 2 months. In that case, maybe a line of credit might be better suited for you versus a mortgage. Now, however, let's talk about different stages of the differences here, meaning in qualification. A refinance, cashing out and refinancing on a traditional mortgage, usually the restrictions are less. It's easier to qualify. Let's say your credit is not so perfect. Refinance lines of credit is a little bit more tighter. Usually require a credit score 700 or above. What we call DTIs, or debt to income ratio. Your debt to income ratios are more restricted. Now, one thing I don't like about HELOC personally is that the interest rates are always adjustable.
Okay.
Versus a mortgage where you have fixed interest rate. Honestly, to go back to the question, what is your advice? What do you pick? With today's low interest rate, I'll vote for a mortgage, for a fixed rate. Because how could you get wrong with a 2.8 or 3% or 3.2 or 2.7 interest rate, versus a line of credit where, yes, today, when we start, interest rates are low on them. But they're adjustable, and they're adjustable based on the prime rate, So traditional line of credit, and guys, there are different products everywhere, but a traditional home equity line of credit is based on the prime rate, which the prime rate today for a home equity line of credit is 3.25%. Now, usually the bank, when they build these lines of credit, they charge you whatever the prime is, meaning whatever the bank is paying to borrow that money, plus what we call a margin. A margin is whatever this bank makes out of you as a profit. It varies depending on credit scores, debt to income ratio, and loan to the value of the property. If you're getting a line of credit and you're maxing out to 90% of the value of the property, you're going to have a much higher interest rate than if you're getting a line of credit at 70%, for example, of the value of your property. Now, line of credit, a good thing about them is the two good things I like about line of credit personally is that the flexibility, meaning you don't need the money now, you don't draw it now. It acts like a credit card against your house. And two, the closing costs on a line of credits are lower, generally speaking. Okay. Now, what I hate about lines of credit is the interest rate is adjustable.
Yeah.
And if you manage your finances properly, guys, that's not a big deal, you know. But you gotta account for that, and don't forget, oh, not only my minimum payment. You gotta make sure you're making the extra payment toward principal and pay down that line of credit. And the other part is that generally speaking, lines of credit, the interest rate is higher than a mortgage. Almost in 99, I don't want to say all the time, but 99% of the cases, your interest rate on a line of credit is higher than when you get a mortgage. And that distance becomes great depending on if you're on a first lien position or a second lien position. You know, a second lien position, the discrepancy is larger. Now, on a mortgage, what I love and what I hate about a mortgage, pretty much, honestly, I love a mortgage better because you have that stability of a fixed interest rate in there.
Right.
You can choose your term. You can choose like
Yeah.
Some people I don't want a 30-year. Most people don't know. Look, we have 15-year. You have a 10-year. You have 25 years. You can choose a different term, or you can control the term by sending extra towards principal. But the fixed interest rate with today's low environment, that's a big point for me. Now, what I don't like, the only negative portion is that the closing costs on a mortgage are traditionally a little bit higher. But as far as a guideline from someone who does this, the guidelines are easier because you can find for example, I can do a mortgage for someone with a 600 credit score and get them a cash out versus a line of credit that specific client won't qualify because you need a minimum, for example, 700 credit score and certain lines of credit products. So pretty much that's it in a brief, unless you have, do you have any questions, Shawn, or someone in the audience maybe want to ask a question or something you wonder about?
No, we're going to just discuss because we are streaming this in 7 or 8 different channels.
Okay.
So let's do this like as a discussion. Like I like the authentic information you're giving. That definitely the line of credit will have a less very minimum closing cost, and traditional mortgage, of course, that's it. The normal cost, the doc stamp and all the stuff. There's a different fees.
Correct.
But the good thing is, but both has their good and bad. Or not bad actually, but different scenario, different things. So, and I like the thing you say that it's all depend on what is the best for them. For the client, for you actually, for what is best for you. So that is the one of the things, George, I love about it. Like you always analyze the scenario and you give the product is best for that particular family. Yeah. So for my side, from the real estate side, I like to share, like, say somebody want to get $100,000 out and want to buy a second home or investment, rental property. I believe that, after discussing with you, that refinance will be good because you're taking the money out, you're putting it, you're not even touching the money or it's not sitting in your bank. But then suppose, you want to take $100,000 out and then you want to do a fix and flip. Sometimes maybe a line of credit is better because kind of like a money is moving, you have the money in the bank because let's face it, we are human beings. When the money is sitting in the bank, what happens? More vacation plan.
We spend it.
Always there's an emergency out there, and that money, so if someone is very strict with their, finance control, like, or not very strict, at least they know how to manage their finances. And if it's a property, like a fix and flip, money coming and going, probably, my opinion will be get the line of credit. But then again, what you say that under 3% interest rate, locking it for 30 years, hey,
I know, man. That it can't get any better than that. That's where my advice comes in. Look, I'm not gonna say one is better because, like I mentioned, I genuinely believe in this. We structure there is no right or wrong here. Is refinance wrong or line of credit wrong? There's no good and evil here with refinances and traditional mortgage versus Heloc. There's a scenario that best fits what you want and what you need, plus what you qualify for. And that's why I recommend everyone, guys, don't say, or like, hey, this is what I want. be open-minded. Let's discuss it. This is at the end of the day about your future, your money. Look at it objectively. Say, why do I want to refinance? If it's simply to lower your interest rate and you need a little bit of cash, obviously, do a mortgage here. Don't do a line of credit. If you don't know if you need the money, but you want to be ready, then yeah, line of credit might be the scenario. But let's discuss it. If any of you is interested, just give me a call, and we can discuss it and choose the best option that's best for you and for your family. At the end of the day, this is what I tell everybody. Guys, your house, your money, your life, your decision. I'm just here to make this easier, hopefully, by giving you the different options, and in some scenarios, just give you a little bit more education on how the process works and what's the cons versus the pros on each product you're interested in. That's all.
Right, right. Now, I see one question here that the interest rate for the investor, like if someone is refinancing in an investment property, is that a little bit different than the primary home?
Correct. Interest rate on investment properties is traditionally higher. On average, assuming two comparable scenarios, an investor cashing out or simply doing a refinance is on average around 1% higher. This varies. This is no like formula goal written in stone, if you want to call it. This is the average throughout the years. Let's assume a borrower today refinancing a traditional mortgage. Let's say that same borrower have a primary residence versus an investment property. And let's say, again, for this example purpose, you qualify for 2.75 interest rate for a 30-year fix on your primary. On investment, you can expect, I would say, anywhere in the range of, let's say, 3.6 to 3.8. That's realistic to expect that. I would say on a best case scenario, around 0.75% difference. On an extreme scenario, it could be up to 1.5% difference. So on average, I'll take the formula. Okay, it's on average around 1% higher when you are refinancing on an investment property. And it's worth noting that lines of credit on investment properties are a lot more difficult. So if you have investment property, usually the recommendation is get a traditional mortgage.
Okay, that's good. That's good. Now, let me ask you something. I see another question here about so somebody bought a house and they have equity, and then, for example, they refinance now, and it could be any kind of refinance. So I see a lot of people, they're refinancing to adjust the interest rate.
Mm-hmm.
And some people, they're like, they have 30 year of mortgage. They say, what, we're going to live here, so just do a 15-year. And because of the interest rate low, the payments are not high, even though doing for 15 years. So those are advantage. Now, the question we have here, if suppose somebody refinance the home and then say tomorrow, next year, they want to sell it, is there any restriction to sell, after refinance, or they can, if the situation changes, they're okay to sell anytime?
That answer depending on the mortgage they got. Generally speaking, if you did a conventional loan or an FHA loan or VA loan, a traditional institutional loan, there are no restrictions. Luckily, most banks and the regulators decided to avoid what we used to have in the past, like prepayment penalties where the bank got you say, oh, you got to stay in this house for 5 years. Luckily, these no longer exist in majority of institutionalized product. However, if you have different products, like what we call non-QM products or non-conventional or private financing, you got to check on the closing disclosure or on the note that you signed at the time to see if you have any prepayment penalties there. Usually you can sell anyway or you can refinance anyway. You just want to double check. And if you're in doubt, guys, call me, call Sean. We definitely can look over the paperwork and properly advise you. But generally speaking, if you have a conventional loan through Fannie Mae, Freddie Mac, FHA, VA, you should not have any prepayment penalties and there are no restrictions to sell.
Okay, perfect. Thank you.
However, one more comment in there. Guys, if you're planning to sell in 6 months, don't refinance. That's my advice here. If you're planning to sell even in a year, look, when you refinance, there are costs. The process is you got to do an appraisal, survey. There's an attorney or a title company. There are lender fees. There are government fees, it costs you money. If you will know yourself, like, hey, I want to refinance today to get, let's say, lower my interest rate from 5.25 to 3.25 or 2.8, whatever it is. That's awesome. That's great. But if you're planning to sell in 6 months, all the savings you did on your monthly payment is gone because you paid a ton of closing costs when you went through that transaction in there.
Yeah.
So don't refinance if you're planning to sell within 6 months or even a year.
Yeah.
If there are no plans, and again, no one knows what the future is, of course, I tell everyone, don't wait on the sidelines anymore. These interest rate environment is not going to last forever. We've been enjoying the party for the last 9 months, I think, by now, around 9 months. Historically speaking, again, no one can predict the future, but generally speaking, these environment of low interest rate last anywhere between a year and a half to 2 years tops, So we're already 9 months into it. So if we're lucky, we're going to have another year of this low. And again, the interest rates not going to go up between one day or the other. They start gradually climbing. So the longer you wait on the sidelines, the most likely you're going to have a higher interest rate. So if you're looking to buy, call Sean, call Sean's team, and start looking for a house, and let's lock you in on a low interest rate. If you're planning to refinance and cash out, don't wait. Do it today. That's the biggest advice. If I'm going to give you now, do it now. Move.
Yeah, that's true. When it comes to the interest, yes, definitely. The other question we have, we see this mortgage forbearance program.
Mhm.
So due to COVID, of course, is that going to? What do you think about the is going the effect to the new buyer or future buyer on this?
Okay, so look, forbearance is a great option that banks or lenders are offering in there if you cannot make your payment because of COVID, whether that illness or you lost your job or one of the partners or spouses lost a job and can no longer afford their mortgage payments. It's a great option. I recommend you reach out to your lender, explain your situation, and apply for a forbearance. However, do not abuse the system. Unfortunately, at the beginning of this pandemic, a lot of folks said, "Oh, it's a party. The lenders, banks are offering forbearance, so let's do forbearance." It is true that the forbearance does not affect your credit. That's the point of it. The forbearance pretty much is you can't afford the payment. You reach out to the lender and say, "Guys, I cannot afford my payment." Pretty much what the lender does is pauses your payment. You do not make a payment, but they don't report any negative information to the credit bureaus. Therefore, the credit won't get affected, and they cannot start any foreclosure process. You're not considered in default. They cannot charge you any late interest or late fees. That's great. But guys, you still owe the money. This is not a forgiveness of debt. So if you say, for example, you went into forbearance in March because you lost your job, and in May you got a job. So okay, now you can afford that mortgage payment again. I recommend you reach out to the lender at that time and make arrangements. Because let's assume for 1 second that your mortgage payment is $1,000 per month. If you didn't pay for 2 months, now you owe them $2,000. If you don't make a payment for a year, now you owe $12,000. So be careful of that. This money is not being forgiven. Some lenders will demand that at the end of the forbearance period, you pay them the whole amount. And that could be challenging if you did a forbearance for a whole year. Now, luckily, most lenders or institutional lenders and banks like us will work with our borrowers in a sense, guys, listen, it's been a year, maybe we do a loan modification for you and add whatever you owe to the back of the mortgage, meaning, okay, we'll extend your mortgage by a year, to pay it. Again, that's a great option for someone that needs it.
Yeah.
As long as people, unfortunately, have been many situations where they abuse it. And let me tell everybody, guys, if you are in forbearance, you will not qualify for a refinance or a line of credit or a new mortgage as long as you're in forbearance. Forbearance means you calling your bank telling them, I cannot pay you. I need you to pause my payment because I cannot afford doing this payment. On the other end, you're calling it a different lender saying, oh, I want to buy a new house. You're not going to get a mortgage as long as you're in a forbearance. And different banks, there's no unified rules on this. Unfortunately, some banks put some kind of penalty in there, meaning if you are in forbearance, you will not qualify for a new mortgage unless you're out of forbearance and you are making payments on time for 1 full year. You will not qualify for more. That's some banks. Luckily, we adopted a more, here at PRMI, we adopted a more aggressive position. And we're like, look, we'll do a loan for you, but you got to be out of forbearance. As long as you pay what you owed and you're out of that forbearance, we can do a mortgage for you tomorrow. But that's not everybody, So again, it's a great tool to have if you need it. But guys, please don't abuse the system, because when you abuse the system, it takes away from other folks that truly need it. If you need it, call your lender, make arrangement, get it done. If you don't need it, don't do it.
Great advice. Great advice. So, George, a lot of great information. Thank you very much for joining in today. And we'll definitely get you back with some other subject, because in the home loan industry, there's so many different things to talk about. There's so many different things to learn, So today, regarding the refinance or Heloc, we definitely had a great clarity. And guys, thanks for joining. And hopefully our discussion or the information George provided is going to help you. If you have any question, put it in the comment. We'll reach out to you for sure. And we are here to help you. Thanks for joining today. Thanks for watching. And we'll see you in another episode of Pro Advice next week, same time here on Tuesday, 10 o'clock. Thank you. Bye.
Thank you for having me, Sean.